Well, good day traders and welcome back. It's been a few weeks now since we've done our week ahead video, a look ahead at what's going to potentially move markets, how the structure and rhythm and feel of markets looks in terms of the implied volatility, which I think is the epicenter of financial markets. It dictates not just our risk management, our position size, it dictates the strategy that we're going to deploy in markets, and we'll talk a little bit more about what's happening in terms of carry structures at the moment. But certainly that's what we're looking at the moment. We're looking ahead for the week and trying to get the mindset right, the psychological aspect, and giving the platform really to try and get an edge in these financial markets. But let's set the scene as we always try and do and look at how markets have FX markets have performed over the last 5 days. As you can see here from the Bloomberg chart, it's the Swissy, which is dominating market procedure. That's the strongest currency, not just over the last 5 days, where you can see the Swiss franc has gained against the US dollar by 79 basis points, 0.079 of 1%, followed by the Danish, the euro, and also the krona as well is having very modest gains. The Japanese yen is underperforming. So, if you look at our own internal exposures at the moment, we're seeing really good buying of the Swiss franc. We're seeing people looking to sell the yen against various currencies. I think that's not just a reflection of what's happening in carry, but also the idea that you're seeing global equity markets moving up quite sharply, and you've seen high yield and investment grade credit spreads looking very, very tight at the moment. Against US Treasuries at the moment. So certainly the yen under a bit of pressure. In fact, if we take that out to the full year, you can see that the Swiss franc has been the best performing currency for 2020. We've seen the Australian dollar down 1.7%. We'll talk a little bit about that at the moment. But that's certainly where we've seen the strength. If you keep things simple in FX markets, you try and buy strong, you try and sell weak. The Swiss franc has been the dominant factor. In fact, if you have a look at the chart there of the two most popular safe haven currencies there, the Swiss franc against the Japanese yen, it's been a really strong trend there. So Swiss yen looking really nice at the moment. The question is, do you put new money to work and take out new positions now, knowing that the trend is fairly mature, or do you look to try and fade this market? For me at the moment, I've got no exposures on this currency cross, but certainly if I was doing it, I would be following the trend and putting money to work on the long side there. If you have a look at equity markets, I think this is a really interesting one as well, because they have been on absolute fire. The US earnings season continues to ramp up as we go through this week, and that will be interesting just to hear what CFOs and CEOs are saying about the future earning capacity, because valuation in equity markets now are at nosebleed levels. I mean, we here look at the ASX 200. If you have a look at the Bloomberg chart there, have a look at the second from right column, you can see the ASX 200 up nearly 6%, best performing equity market globally in terms of the developed markets anyway. That's following on from obviously some staggering gains in 2019. We were sort of seeing in the camp that, obviously with central bank action, liquidity that's happened through markets, which have really been the penultimate driver of markets. Of course, we can add in buyback, super low volatility playing through, and obviously people who are volatility targeting funds, who use volatility to understand how much they can be invested in equity markets, and obviously you've seen very tight credit spreads as well. You've seen a situation where markets just continue to push higher and higher and higher, and I think ultimately the question is can these go higher at the moment until those dynamics change? And as I say, liquidity, super low volatility, central banks really happy to step in should we see any kind of problems, and the market obviously feeling quite underpinned by that situation. But let's not discount the stability we've seen from the data flow. I mean, look at the China data we've seen this week. I am saying this before with GDP numbers for my sins, but certainly if you look at the credit data, which I think is probably the most important one for me, look at M2 money supply in China. That's been pushing up to the highest level since 2018. New yuan and aggregate financing numbers were better than expected, and that credit impulse that we're seeing in China, which is improving, should really benefit the PMI structures, which of course we are looking very closely at. So China data obviously being very good. You've seen a situation where data around the world has been stabilised. I'm not saying it's been improving significantly, but the data has been stabilising. And what the most important situation for me in terms of equity markets is the idea that real yields, if we inflation adjusted bond yields, they are moving slowly lower. Now, if they were moving higher, and the rate of change is obviously key there, then I think would be a big headwind for equity markets. But the fact is that we're seeing stability in the data flow, and real yields are moving lower, and that's why equity markets, in my opinion, are really benefiting from that situation. Now have a look at the interest rate structure as we go into the new week. I think obviously the interesting one here is what's happening in the Bank of England. We can have a look at the next meeting, which is going to be the 30th of January, and we can see that the market is pricing in a 61.6% chance of a rate cut there. You know, that's obviously a subject of much debate on the trading floors. You know, you saw sterling on cable trade below that 130 level. There does seem to be a decent level of support against that. Obviously, if you wanted to short the pound, you do so against the Swiss franc. I think that's really where you've been getting the big bang for your buck in that situation. But certainly, you know, the pound is a really interesting currency because that meeting now on the 30th of January is a live one. Will we get the 5 MPC voters to go on there? Well, we know we've definitely got 2 on there. The question is will we get some people like Carney coming on board? Now, as we go into the new week, what you are looking at in the UK is the jobless claims. Will they cement the situation and require the MPC to vote on that near-term cut? Not so sure, but I think if you go into the latter stage of the week on the 24th, you get the PMI numbers coming out of the UK, and if they're weak, then I think, you know, that will really cement the idea that the Bank of England are going to have to cut rates on that 30th of January, and we'll probably see that implied rate cut structure probably closer towards 75%. Have a look in Australia. You can see, again, this is a live meeting that's going to take place on the 4th of February. The interesting, of course, of that situation is it comes one day after what's going to happen in the Iowa caucus, which I think is really interesting in itself because we now really need to start focusing on the US election and what's happening most prominently amongst the Democrat nominee after this week's TV debate. I think, you know, Buttigieg looks pretty good. I think you've got Elizabeth Warren, I think actually debated quite well, although, you know, both of those candidates are not seen as a front runner relative to what we're seeing with Biden and Sanders, for example. So I think, you know, that's something we are looking at very closely is that Iowa caucus, because if you look at the last 11 elections, the nominee for the Democrat Party in 75% of the cases has been predicted by the Iowa caucus. So I think that's something we're going to look at very closely. Implied volatility in dollar yen and the VIX, for example, does tend to rise a little bit over that after the Iowa caucus. So that's something we are looking at. But certainly, if you're looking at the RBA meeting again, we go back to the rates charts. You can see that second from right column, 54.5%. I think the interesting thing as we go through the week in Australia, we do get Westpac consumer confidence. I'm not expecting that necessarily to be a big driver of volatility. But what we are expecting to be a driver of volatility is going to be the jobs number on Thursday. The market's looking for 13,500 net jobs, and you know, the unemployment rate to stay about 5.2%, the participation rate around 66%. That is going to be a big driver because the market, as I say, is pricing at just above consensus view that we are going to see a rate cut. If we get a weak jobs number, and the trend has been for decent job creation over a period of time, but if we do get a poor number there, and again, it's the mix that we're looking at, full-time, part-time jobs, what does that participation rate do? If we don't see a particularly good number, the market will start to price that rate cut around about sort of 60-70%. The Aussie dollar has been a good level to sell above 69 cents. It hasn't really got much stability above that level, but I think if we start pricing in 60-70% chance of a rate cut here in Australia, you know, we'll get pushing down to the sort of the low 69 cents by the end of the week. That's something we are going to be looking at very closely. Elsewhere, there's not really too much. The Bank of Japan is a little bit being priced in terms of that. You go over what's being priced over the next 12 months, you can see on that far right column, you know, it's really what's happening in the Bank of England. The market's pricing in 33 basis points of cuts, so just over one rate cut coming through there. But markets have been a much more sanguine. I think part of the reason we've seen super low volatility in markets and you know, obviously positive trending equity markets, tight credit spreads, is the idea that these central banks will support should they need to do so. Again, we've got that sort of underpinning that central bank put on a global basis, that synchronized move, something we are looking at very closely. So those rate structures very, very interesting indeed. Now we go to the implied volatility report. Now in terms of what's actually happening, I will touch on just in terms of what's happening elsewhere. We do get the ECB meeting that will need to be focused on. PMIs coming out of Europe as well. And also in the US, we don't really get too much in terms of that. We get market manufacturing numbers, leading indicators, but you know, not significant amounts ahead of the Fed meeting there. But have a look at the you know, on the left hand side, you can see realized vol. Most of you probably be using average true range or Bollinger Bands. You can see those there. But I tend to look more closely at what's happening in implied volatility. The markets had a look at all that data that I talked about there and said, you know, we're just not expecting moves to take place. Have a look at the implied vol structure. You can see in that sort of orangey, sort of peachy colour there that we've got. most of those currency crosses you can see, with the exception of Aussie yen and also Aussie CAD, are below the 20th percentile, so very, very low. In fact, if you have a look at the chart of the JP Morgan Global FX implied volatility measure, that sits at 5.28%, which in layman's terms is actually the lowest levels we've ever seen. It matches the number that we saw in July 2014. Implied volatility in FX markets is absolutely shot to pieces. It's disgusting. You know, we're looking at what's happening there. The market is just lacking any kind of pulse. We time and time again talk about implied volatility coming up. It's the time to buy volatility. Traders sell straight into that situation. But if I actually have a look at the implied volatility structures, you can see just next to the left-hand side of that, you know, you look at sterling Aussie, 6.43%. That's disgusting. You got Aussie yen, 7.5%. Aussie CAD, dollar CAD, 4.6%. These markets are lacking a pulse. So I said, go into the actual implied move in price by the straddle. So this is giving you the expected move up or down from the current spot price that we're talking at this moment in time, with a 68.2% level of confidence. So this is what options traders will trade to understand the expected move. You can buy and sell volatility around that, but I like to use this to say the expected move in spot prices with 1 week expiry. You can see sterling Aussie 174 pips, but then you go down into the likes of the Aussie dollar, 45 pips. Now, despite the fact that we've got jobs data, despite what's happening in the US, despite what's happening between other factions as well, you know, you've got a market that is expecting Aussie dollar to move up or down 45 points. You can see there the expected range, 69.42, 68.52. So again, you know, very tight ranges to be seen. Have a look at euro dollar, which of course is right at the epicenter of that low vol. The market's expecting that to trade in a 53-point move, so just over a 100-point range effectively, 111.91, 110.85. Go down into some of the other volatility measures we look at. The volatility of the S&P, or what we call the VIX index, trading 12.3%. That's the 5th percentile of the 12-month range. Treasury volatility trading at the 13th percentile, 3.74%. Oil and gold vol still pretty low. I think gold looks quite interesting. We talk about real yields moving lower. If that continues to be the trend as we go through this week, then you know, gold's going to start finding a bit more buyers playing through. So we look at this vol report, and I think, you know, if you look at what's working really well, you look at our flow, you look at what's working really well, it's being carried. People want to be paid to be in positions. The emerging market complex, and I didn't actually talk about the performance there, is doing really well. Have a look at the Indonesian rupiah, doing really well. The Indian rupee, the Filipino peso, very, very strong at the moment. The Colombian currency is doing very, very nicely at the moment. These emerging market in LATAM and also in Asia working very, very nicely. I suppose part of that is also down not just the liquidity aspect, but also the positive feel around US-China trade that's been talked about quite openly. Have a look at the other markets there as well. We talk about the positioning. Have a look at commitment of traders report. You know, these markets here, you know, this will come out and get a refresh on Saturday, but we're sort of still in positioning on a lot of these markets, still sort of going into the top end of the percentile ranking there. The dollar, obviously an interesting one there. Have a look at the risk reversal. So we're looking at the skew of call volatility to put volatility on 1 week expiry. Again, you know, Aussie dollar 91 percentile. You know, it's negative, so people have been slight better buyers and still have this propensity to buy put volatility and downside over calls, but that has been moving higher. It's at the 91 percentile. Gold, I think that's an interesting one as well, because if you look at 1 week risk reversals, that skew of put volatility relative to call volatility, that's at the 39th percentile. So it's come back to much more neutral positioning and expectations around gold. I think that's therefore, you know, a good time to be looking at gold exposures in that regard if we do see those real yields moving lower. So again, we're looking at a situation where carry's working very nicely. Obviously, that's a backdrop of wanting to be paid to be in positions. That's working quite nicely in an equity market that just really can't sell off. Credit spreads are very tight. Implied volatility is very low. The ECB, Fed and Bank of Japan's balance sheets are expanding at $100 billion a month clip. Again, you can't underestimate just how powerful that seems to be for a market that's looking at central bank action and support in that regard there. So a bit of data to play through. I think specifically you really want to be focusing what's happening in the UK and also in Australia. We talked about the rates market there as well. If you find yourself liking this video, obviously go and give this a like and subscribe to the channel if you want to see this every Friday and get notifications of it. If you've got any questions around what you've heard today, do reach out to myself or the team here at Pepperstone.